phrase we're hearing more and more is evidence-based investing. Now, most investment professionals would claim that their strategy is based on some sort of evidence. So what exactly does evidence-based investing mean? Laurens van den Voorn is Head of Investment Strategy at the evidence-based investment manager Timeline.
When we talk about evidence-based investing, it's actually a very specific concept, and it's basically the concept of making investment decisions on the last 100 years, as long as you can get, let's say, at decades of academic research, historical market data, and basically just looking at where in the market have we seen specific characteristics that have proven to actually give investors a decent return, and then just tilt your portfolio towards those, we call it risk factors or premiums. But actually it starts at a much more basic concept. It starts with what has evidence suggested actually works. And we know being diversified, low cost, starting with a broad-based index, we can see that as an evidence-based approach as well, because we know that has worked. We've seen the evidence that low-cost index funds actually has provided top-tier performance. And then once you've got that basic market in your portfolio, you can then tilt your portfolio towards these characteristics that should outperform over the long term.
So what are the characteristics or risk factors that Laurentius is referring to? There are, in fact, hundreds of different factors, but, says Laurentius, just a few flagship factors that investors have to focus on.
You're looking at your flagship factors, and that would be your size. Your smaller cap companies should outperform larger cap companies over time. Looking at the value factors, just saying companies that are relatively cheaper than your more expensive companies should mean revert and outperform. Looking at profitability, that's what I like to call it the common sense factor. Companies that are profitable should outperform companies that are not profitable. Then there's a wider range of other factors you can think of: momentum, low volatility, high dividend yield, and then I can actually extend that to, well, hundreds and hundreds of factors. And I think that's the key factors that we would probably be focused on is your size, your value, your profitability factors out there.
So-called factor investing has come in for some criticism in recent years. Why? Well, factors like size and value have actually underperformed for quite a while. So how concerned, if at all, should investors be?
Yeah, it's always a frequent question that comes up. Let's take value and size, small cap stocks. They have actually underperformed over the last 10 years. Does that mean the factor is not that relevant or that aggressive or that robust anymore? And to answer that question, you need to take a long-term perspective. Not just will it come back, but have we actually seen this level of underperformance in the past? And you can actually look at, especially in the US, you can look at data since the 1920s, even longer back. But since the 1920s, we've got very, very solid data sets. And what we've actually seen is that you should expect periods of 10 years, even longer, of underperformance in your factors. It's called a risk factor for a reason. It's more risky because the asset is a bit more volatile, but it also goes through periods of underperformance.
In short, a well-designed factor-based strategy should outperform in the long run, but there's no guarantee that it will. What we do know is that controlling your costs, being disciplined and focusing on the long term certainly will pay off over time.